Hey guys, Chris from Adapt Tuition here, and in this video, I am going to show you the solution for question 2 from the May 2009 PoA Paper 2. If you want to see the solutions to the other questions on this paper, I'm going to put a card up there and a link in the description below, so be sure to check those out as well. And with that said, let's get into the question. Okay, so they tell us that Stephen Peterson, an accounting student, prepared his father's final accounts. The following errors were discovered by the accounting technician who examined the accounts. Now, what they want us to do is to do the journal entries to correct the above items, and the narratives are required. Now, we're going to go through them one by one. So, the first item up is the sale of goods, 2,500 on credit to K. Martin, had been entered in K. Martin's account. Now, before we get into this, if you need to know how to correct errors, I'm going to put a card up there to my errors playlist. Be sure to check that entire playlist out if you need a refresher. Now, if of course you want to use this video as a bit of a springboard, a jumping off point, feel free to do so. But in my videos, my tutorials, I give you guys examples, explanations, and questions to try with solutions. So you really want to check that out if you need to brush up on your error skills. But of course, if you want to continue with this question, let's proceed. So once again, the sale of goods, 2,500 on credit to K. Martin, had been entered in K. Martin's account. So we could see the reason for the mix-up. The names are real similar. Okay. Now, when you make a sale, a credit sale to someone, you're supposed to debit them and credit the sales account. So we were supposed to debit Martin, but we debited Martin. So Martin is missing a debit, and Martin has a debit that should not be there. So we have two things to correct. We have to put in the debit to Martin, where we're supposed to have been put in the first place. And we have to take out or remove a debit from Martin's account. To do that, we're going to have to credit Martin, because remember, T accounts and double entry, the sides work against each other. So if you have something in somewhere it shouldn't be, you go on the opposite side of the account and enter an amount equal to the amount you want to take out or reduce. Okay, so we're going to pull up our general journal. Now don't forget, in your general journal, right, you have some columns and that kind of stuff, your headings, and when we enter transactions or corrections, we put the debit entries first, followed by the credit entries, and the credit entries are indented, shifted across relative to the debit entries. And of course, a narrative or a brief description is required. So remember, we were supposed to debit Martin, but we didn't. So to fix that, we are going to debit Martin. And we have a debit in Martin's account that should not be there. To remove a debit, you're going to have to do the opposite, which is credit Martin's account. The narrative is simply to correct an error of commission. An error of commission is where you enter a transaction in the wrong person's account, which is exactly what happened here. Okay, let's take a look at the second transaction. So it says that the purchase of goods for $1,575 cash was completely omitted from the books. So this is an error of omission. To correct it, we simply have to enter the transaction as it should have been entered in the first place. When you purchase goods, you're going to debit purchases because it's an expense, and you're going to credit, in this case, cash, because you paid money. When you pay money, your money is going down. Money is an asset. Cash is an asset. To record a decrease in an asset, you have to credit the asset account. So again, we're going to debit purchases, credit cash, and we're going to put to correct an error of omission. Okay, item 3. The purchase of a motor car for $5,000 had been entered in the motor expenses account. No. If you buy a motor car, that's an asset. You will debit the assets account. The motor expenses account is like when you pay for repairs and these things. That's not an asset account. That's an expense account. So we put this in the wrong class of account. That's an error of principle. So what do we do? Well, again, we have a debit to motor car that was not made. We were supposed to debit motor car, but instead we debited motor expenses. So to correct this error, we have to do two things. Enter the item where it should have been entered and remove it from where it was put in error. So again, motor car is an asset. To record an increase in an asset, you have to debit the assets account. So we debit motor car because it should have been debited but was not. And we also have to credit motor expenses because it was debited but should not have been. And we're going to put simply to correct an error of principle. Okay, item 4. It says discounts allowed of $400 had been entered in error on the debit side of discounts received. Okay, so discounts allowed is an expense, and to record the expense, we're supposed to debit the expense account. But we didn't, so we're missing a debit from discounts allowed. To fix that, we'll just debit it. and it was debited, but the discount received. Now, discount received is a revenue, but technically it doesn't matter because it has a debit that shouldn't be there. So what we need to do is we need to remove that debit that shouldn't be there. So to correct this error, we have a couple of things to do. We're going to put the debit to discount allowed where it should have been put initially, and we're going to credit discount received because we put a debit there that should not be there. So that's simply to correct an error of principle because, again, the item was put in the wrong class of account. It was put in a revenue account instead of an expense account. Next, it says the wages account was undercast by $430. Okay, so you see errors with undercast and that kind of stuff, that requires suspense account. If you don't know how to use a suspense account, I'm going to put a card up there and a link in the description below. So check it out and then come back here if you're not sure how to use it. But I'm going to go ahead with this anyway and take it, right? So if wages is undercast means it was too low. Wages is an expense. Expenses have debit balances. If your debit is too low, you want to increase it to fix the undercast, the understatement. And when you to increase an expense, you're going to have to debit it. But if you're debiting wages, where are you going to credit? Was any other account affected by this error? No, it was just that wages was undercast. How do we fix that? Right, that's where the suspense account comes in. The suspense account is an account used to help correct one-sided errors. So we are going to have to debit wages because it was undercast. So we have to increase the balance in the account, which requires a debit because wages is an expense. And the credit will simply go to suspense account because there was no other account affected by this error. But every debit needs a corresponding credit. So we use the suspense account to facilitate double entry. I will simply put to correct undercast wages. Okay, the last item here says that we have to do a receipt of cash from J. Slows for 100 had been entered on the credit side of the cash book and the debit side of Slows account. What? If we receive money, we are supposed to debit cash book and credit whoever paid us. This is a complete reversal of a complete reversal of entries. To fix it, we have to make the correct debit and the correct credit for double the amount. Why double? Because in the first case, we are missing a debit and a credit where they should have been put. So we were supposed to debit cash and credit Slows. We did neither of those things. So to fix that, we should debit cash and credit Slows. Now, we also credited cash, though it should not have been credited, and we debited Slows, but Slows should not have been debited. So we have a credit where it shouldn't be put and a debit where it shouldn't be put. So we have to remove both of those. To remove the credit in the cash book, you're going to debit the cash book, which means we have two debits to put in the cash book. One, to put in the amount that should have been put in initially, and two, to remove a credit that was put in that should not have been put in. And we're going to credit Slows again twice. Once to put in the credit that should have been put in Slows account, and two, to counterbalance or remove the debit that should not have been put in. So in all, what's going to happen, we're going to debit cash book and credit Slows for 200, double the amount. So we're going to say that debit cash book for 200, credit Slows for 200, and that's to correct a error of reversal or complete reversal of entries. Okay, so that's part A. Part B wants us to correct net profit. Let's take a look at that. Okay, so like I was saying, the income statement prepared by Stephen Peterson showed a net income of $24,521, and they want us to prepare a statement showing the corrected net income for the business. Now, before we get into it, I'm going to put a card up there to my net income correction video. That one, I worked extra on that one, put in some fancy features to show income statements and that kind of stuff, and showing how the correction of an error affects the entire thing and how it does so. So I would strongly suggest, if you're not too familiar with how to correct net income after correcting errors, check out that video and come back here. But I'm still going to explain in detail how to do this using this question. So let's get there. So of course, just head up your statement, very simple. Stephen Peterson, statement of revised profit or corrected net profit. And we're going to start off with the $24,521. That was the net income before corrections. Okay, let's go through item by item. So the first item, we had $2,500, a credit sale to Martin, that was put in Martin's account. Okay, so that does not affect the income statement. It is a sale, but the error was on the debtor's side. So that's not going to affect the income statement. Next, we have the purchase of goods was omitted. Right, purchases is an expense. If it was omitted, that means it was left out. If you leave out purchases or an expense, it means your expenses are going to be too low. If your expenses are too low, your profit is going to be too high. So when we fix that, we're going to have to put in the purchases that was not there, that was missing. And when you put it in, your expenses are going to go up. When your expenses go up, guess what happens to profit? It comes down. So in this case now, we are simply going to put less omitted purchases, 1575. Okay, next, we have the purchases of the purchase of a motor car for $5,000 have been entered in the motor expenses account. Okay, so the motor car was $5,000. That should have been debited to motor car as an asset. We put it in the expenses account in error. So it means that the expense account balance was too high, which means we took away too much in the calculation of profit, which means profit is too low. So when expenses are too high, profit is too low. When we fix that now, we're going to take 5,000 out of the expenses account. So expenses are going to come down. When expenses come down, profit is going to go up. So you're going to see that here. When we correct it, profit is going to go up. So you're seeing here, add overstated motor expenses, 5,000. Okay. The next item, let's see. We had, this thing with the discounts, right? So this one actually netted off. So discounts allowed of 400 have been entered in error on the debit side of discount received account. Okay. So let me tell you why we don't actually have to do anything to correct this. So discounts allowed is an expense. If you omit an expense, it means your expense is too low and your profit is going to be too high. So yes, you should make a correction for that. But look at what actually happened. We debited discounts received. Discounts received is a revenue, and revenues are supposed to be recorded with credits. If you put a debit in the revenue account, the revenue is going to be too low. So check this. Because we omitted discount allowed, your expense was too low. We debited discount received, so your revenue was too low by the same amount. So the net effect on profit is going to be 0. So when we fix both of those things, profit is going to stay the same, right? So you could put both corrections in if you want, but they're going to net off any way you take it. So I didn't think it made sense to enter those. So it would have been unnecessary or kind of redundant, right? But of course, if you put them in, nothing is wrong with that. As a matter of fact, the question was worth 7 marks, so it might have been worth it to put it in, all right? Next, it says the wages account was undercast by 430. Right, so wages is an expense. Undercast means it's too low. If your expense is too low, profit is too high. When you correct the error, so wages being undercast means it was too low. When you correct it, expense is going to go up, which means profit is going to go down. So we're going to put that here, right? Where to go? Right, there we go, right. Less undercast wages, 430. Now the last error was a reversal of entries that had nothing to do with expenses or revenues. It was just a receipt from a debt. I'm assuming a debtor. So all we have to do now is add and subtract, do the arithmetic, and we're going to get 27,516 for corrected net income. And that's the end of this question. Okay guys, so there you have it. That's the solution for question 2 from the May 2009 POA paper 2. If you have any questions about it, please feel free to leave them in the comment section below and I'll get back to you when I have a chance. If you want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe and be sure to check out my website where I have some pretty useful POA handouts. Anyway guys, as per usual, thank you so much for watching. Take care of yourselves and I'll see you next time. Bye.